Good morning and welcome to our mid-year market update webinar. I'm Angela Strangman and I lead the marketing efforts here at TrustPoint. We're so glad to see so many of you that were able to make the call today, and we appreciate you joining us. Before we get started, I just want to mention that we've had a number of inquiries about when we will have our next Charts and Chatter event, which is what we call our in-person event when we do these market updates. We're excited that we're tentatively planning for an October date, and more will be coming out on that. But there's a lot that can happen, obviously, between now and October. So we just want to make sure we're following any CDC protocols and watching the transmission rates. But it is exciting to know that potentially we could have another Charts and Chatter yet this fall. Make sure that we have your email address as usual, and that you're getting our monthly newsletter Viewpoint as well as any of our email notifications so that you're the first to know when we decide if we can have that event or not. For today, our session will be recorded as we usually have done in the past, and it will be located out on our website, trustpointinc.com, under the News and Insights tab. Under that tab, you can also find other articles, past recordings, past articles and newsletters, as well as our weekly commentary on the markets. If you want, this is a new feature, you could go to the weekly commentary and you can actually sign up to have that delivered directly to your inbox every Monday morning. It's a very quick paragraph on what had transpired in the past week that affected the markets. So again, under News and Insights on our website is the place to go to check that out. Thank you for all of you who previously submitted questions prior to today's presentation. We actually wrapped those answers into today's presentation, but we're also encouraging you to ask questions at any time throughout the presentation using the Q&A feature on your Zoom session. We're going to try to get to as many of those at the end as time allows. We're hoping to wrap this up around 11:45. So talking about today's webinar, we do have Jan Arsenal, who is our CIO and leads our Chief Investment Officer and leads the team, the investment team. He is not a new face to webinars. Most of you have seen him before. And if you are getting our Market Point newsletter on a quarterly basis, he also does the video recap for that as well. But he is joined today on the virtual stage, if you will, by two other investment team members, Ryan Bergin and Steve Brudos. They're going to kill me. I swear I practiced. So they're going to be joining him on the panel. And without further ado, I'm going to let Jan introduce those two as well as get the webinar started.
Well, good morning, everyone. Thank you very much, Angie. Now, we certainly appreciate you taking the time to be with us this morning, so thank you. I'm just going to share my screen now, and we'll get going. So we'll cover a number of topics today. At the top of the list, we certainly want to talk about the impact of the Delta variant on economic growth. The recent surge in inflation will also be addressed, and more importantly, what are the implications of rising inflation for both bonds and stocks? And to conclude, we'll try to answer probably the most asked question from clients. Is there still upside left in stocks? So without further ado, let me introduce my colleagues again, Steve Brudos and Ryan Bergin, who will be joining me for the conversation this morning. Steve is an investment analyst specializing in fixed income markets, while Ryan is actually joining us from a Minneapolis office, is our portfolio manager specializing in equity markets. Both have tremendous knowledge of their respective asset class, and I'm certainly delighted to have both with me this morning. So Steve, Ryan, good morning, and thank you for being here.
Morning. Good morning.
So before we talk about the future, we thought we would spend a few minutes discussing where we've been and where we've come from. The first half of the year has been really good for investors, with equities, as shown in gray with the gray bars here, and real assets in light blue, producing really strong returns. Bonds in dark blue on aggregate lagged the returns of equities and real assets, but there were certainly, as you can tell, looking at the chart, pockets of the bond market that also produce good returns. Now, despite the strong gains we have seen in equity markets over the last 6 months or so, we still think there is value in equities. And I'll ask Ryan to discuss the topic in more detail in a few minutes. Now, if I learned anything over my career, it would be that generally speaking, you want to be bullish on stocks unless you have good reasons to believe there's a recession right around the corner. And the reason is simple. The business cycle really drives the performance of stocks, and stocks don't meaningfully correct unless you have a recession. And since we're not anticipating a recession over the next 6 to 12 months, we remain generally positive on stocks. Now, the best time to be in stocks is when economic growth is positive and accelerating. And so far this year, as the chart shows, economic growth in the US and abroad for that matter has been both positive and accelerating. I would say even surpassing the expectations of even the most optimistic economists. So it shouldn't be a surprise that stocks have done well so far this year. This is the best environment for stocks when growth is positive and accelerating, especially when combined with easy monetary and fiscal policies. So on the fiscal front, and I think that's important to recognize that none of that good growth, none of that good economic growth would have been possible without the help of governments. What the chart shows here is the fiscal support in 2020 as a percentage of gross domestic product. And the numbers are compared to the 2009 response from governments that followed the banking and credit crisis. I think we all remember. So truly amazing how much money has been spent by governments to provide support during the pandemic. And there's also no doubt that the US has led the effort here, as fiscal stimulus in this country remains, as you can see, well above, well ahead other countries in terms of scale. The chart here does include the 1.9 trillion American Rescue Plan passed earlier this year, but it does not include anything related to the infrastructure plan or the families plan currently being discussed in Washington, which if passed, if both would pass, could add another 4 trillion or so to the economy, or about 20% more in relation to the 2020 GDP number. And with interest rates near record lows, there's certainly an incentive for governments to continue to go big on spending. And the reality, though, is that governments didn't do this alone. I think we all know that. Central banks led by our Federal Reserve also came to the rescue. A point I think we emphasized many times in previous webinars and also in previous written publications. Here, the chart shows the aggregate value of all government bonds held by the 4 major central banks around the world. So these are bonds that central banks have purchased in the open market with newly created money to facilitate the issuance of government debt at low borrowing cost. So the bottom line here is pretty simple. Governments and central banks have worked together and have been the main catalyst behind this fast recovery in economic growth. And with fiscal and monetary support set to continue, in our opinion, the probability of an economic downturn is reduced. And by itself, this is a good reason to remain generally positive on the outlook for equities. Now, the amount of monetary and fiscal stimulus is also one of the reasons why inflation has become a hot topic domestically. something I'll ask Steve to address in more detail in a few minutes. So just to conclude on this, the approach used by governments and central banks worked beautifully. The proof, I think, is in the pudding. The US recession lasted only 2 months, the shortest recession in almost a century. Even more impressive, the bear market in stocks, which is not shown on this chart here, lasted only 1.1 month. Also the shortest bear market in almost a century. So truly amazing. And with that much support from government and central banks, we believe that the expansion is not gonna peter out on its own. So the question for us is, so what may derail the expansion then? Well, as I mentioned, inflation is a potential risk. And here, I think I'll ask Steve to share our thoughts on inflation. But before we do this, I think I would like to ask the audience on the call today what they think inflation has been on average in the US over the last 75 years. So what I'm going to do next is open a poll question, and I'll give everybody a few seconds to answer the question. Thank you for your votes. I'm now going to share the results.
So thank you for participating in the poll question responses. The next slide will illustrate what the exact answer is, but before I get into that, I'd like to get into kind of current inflation and how it compares to past. So if we look at the next slide, inflation has certainly been a hot topic over the last few months. The chart here shows rolling 12-month inflation going all the way back to 1948. And as the global economy has reopened over the last, say, 12 plus months, the surge in demand that we've seen for goods has really outpaced, supply chains, causing some disruptions and some higher prices for goods. And the current level of inflation we're seeing now is quite new for a lot of investors. For baseball fans out there, we have to go all the way back to the early 90s when the Twins last won the World Series to see kind of some of these same levels. The point is really, though, that a lot of time has passed, and it's certainly not surprising to see, this gather so much attention because for the most part, inflation has been relatively low over the last couple of decades. However, in the answer to the poll question that was just out there, 3.5% inflation has been the median level. And that 3.5%, hasn't in and of itself led to significant corrections in the markets. Periods of hyperinflation, however, similar to the wartime eras or the 70s, certainly can pose a bigger risk to the economy and markets. So the question is, do we think we'll get this type of runaway inflation? And the short answer is no. We do see low probabilities of hyper or runaway inflation. And in the next chart, if we look at the dark purple line, shows core CPI going back to 2006. And core CPI is the consumer price index, excluding food and energy, and it's certainly a broad measure of consumer inflation. And the recent June print looks rather surprising, and it is. However, it is important to note that some of these disruptions remain mostly isolated to pandemic-related high demand items that are certainly having an outsized effect on core CPI right now. So you want to think about appliances, recreation and goods, autos, hotels, and airfare, areas of the market that were most impacted by the economic shutdown. And these are some of the same areas that are seeing the most price pressures as economies have, opened back up. And some of this pressure is starting to ease as supply chains have improved somewhat. And some of those high demand post-pandemic items are not likely to continue to have, some of the same year over year price increases. So if we look at the lighter blue line, which excludes some of those that I just mentioned, those pandemic related items, inflation appears much more subdued. And because of this, this is the primary reason, that economists and the Federal Reserve certainly feel that inflation will prove to be transitory. So for inflation to stay elevated on a more sustained basis, we'll need to see more economy-wide price pressures or price increases, especially in the categories with larger weights in that CPI bucket. And some of those are healthcare, rents, services, inflation. So currently at TrustPoint, we're not necessarily in the camp that we're going to see runaway inflation, but we also believe that inflation may not be as transitory as the Federal Reserve is currently indicating. And the next slide I show will illustrate why we think that inflation may be stickier down the road. And first, looking at the chart on the left, this is owners' equivalent rental prices, and they are expected to pick up shortly. And rents are a large component in what the Fed uses to measure or gauge inflation. And a lot of this has to do with surging home prices. Many are now re-entering urban rental market areas following vaccinations. And so what we're seeing is a surge in rental prices and rental prices moving higher. The chart on the right shows that services inflation is starting to move higher as well, but is tightly tied to wage growth. So if the jobs market does continue to improve, which we do think it will, and if we start to see sustained wage growth in the services sector, this should put more sustained upward pressure on inflation. So these are just a couple of the many indicators that we're watching, and why we certainly have maintained inflation hedges in portfolios through not only Treasury inflation protected securities, but also by taking a more cautious approach to interest rate risk overall, as we think inflation could be more persistent over the long run than the market is currently indicating.
Okay, so as you just described, Steve, there are ways to protect bond portfolios against unexpected inflation. But what about stocks? If our outlook is for inflation to be more persistent than what we've seen over the last decade, let me ask Ryan here to talk about the potential impact of unexpected inflation on equity markets.
Yeah, thanks, Jan. I think, first of all, history tells us that global stocks have increased at a much higher annualized rate than inflation. So we should feel or have a high degree of confidence the long-term trend of stocks outperforming will continue. We see in this chart that average annual equity returns have been well above the inflation rates shown in each inflation rate regime that's shown on the x-axis. In fact, in all of the inflation regimes, and only periods of deflation or hyperinflation have stocks lost value. Second, we know that corporate earnings are the fundamental driver of long-term stock returns, and that's something that that we talk about a lot with clients, is that corporate earnings drive stock returns. Inflation's impact on earnings can come through, on the one hand, through higher costs, which could lower profits, lower earnings, but on the other hand, companies are also able to raise prices to offset the increase in costs, which results in really sustainable earnings during more inflationary periods. I do think it's worth mentioning too that over shorter term periods, equity selection, stock selection does need to be a bit more picky, as certainly some areas of the stock market do better than others during inflationary environments. But broadly speaking, stocks are a really, really good place to be when inflation is rising.
Well, thanks, Ryan. Now, besides inflation, I would like to address a second possible risk that some believe could derail this expansion. So we'll talk about the Delta variant next. As shown here, the Delta variant now accounts for the majority of new infections worldwide. And this chart is only 20 days old, but it's already outdated, as the CDC just announced over the weekend that, in fact, over 80% of new US cases are now from the Delta variant, from just, again, if you look at this chart, 52% just 20 days ago. So according to the World Health Organization, the Delta variant is the fastest and fittest variant yet, as much as 50 to 60% more transmissible than the Alpha variant. So we know it's highly contagious, and that's the bad news. The good news is that most vaccines have proven to be effective against the Delta variant. And even though fully vaccinated people can still get infected, the vaccines dramatically reduce the risk of serious illness that leads to hospitalization and death. In fact, according to a recent study, vaccinated people are believed to be at least 10 times less likely to die from COVID than the unvaccinated. The other good news is that globally, vaccine makers are now set to produce over 10 billion doses this year alone in 2021. And with just under 8 billion people worldwide, that means that everyone who wants to be vaccinated should have been given the opportunity by year end. And that is important because the fastest we can get people vaccinated, the faster we get to herd immunity, which in itself will greatly improve the risk associated with the Delta variant. As the table shows here, at the current rate of vaccination, the world should surpass the important 70 threshold, 70% of the population being fully immunized in less than 4 months, so before year end, which is a great improvement compared to where the estimates were just 3 months ago, when back then it was estimated that it would take another 11 months to get the world to herd immunity. And this is the direct result of vaccine nationalism giving way to what we call vaccine cooperation, whereby rich countries are increasingly working with pharma companies to secure doses for the citizens of less fortunate nations. So back to the original question, will global economic growth be derailed by the Delta variant? I think our answer is twofold. Domestically in the US, we would say no. As I just mentioned, vaccinated people have little to fear from the Delta strain, so they will likely continue to go on with their daily lives. And non-vaccinated people, in most cases, are probably not very concerned about contracting the virus, so they too will go on with their daily lives. So in the US, I would say we don't expect major behavioral changes from a potential surge in cases related to the Delta variant. And as a result, we don't expect much impact, if any, to economic activity. And frankly, if you think about it politically, when everyone who wants a vaccine can have access to one, it is really difficult to see how authorities or governments could order lockdowns again. Now, internationally, we would say it depends. In countries where the overall vaccination rate is 50% or more, like it is in the US, we would say no. We would not expect the Delta variant to materially impact growth. But in some emerging market nations, however, where the vaccination rate is still quite low, we would say maybe, but only for a short period of time. So in our opinion, current economic forecasts for global growth of 5.6% in 2021 and 4.3% in 2022, these estimates are from the World Bank, are unlikely to be revised lower. And if achieved, this recovery pace would be the most rapid economic recovery from a crisis in over 80 years. And driving that growth going forward will be continued reopening of economies, which will allow high saving rates worldwide. People we know have saved a lot of money during COVID to be used to satisfy pent-up demand. We also believe that inventory rebuilding will be an important catalyst for growth over the next 12 to 18 months. Now, Some economists are saying that although growth is strong, the growth momentum, or the second derivative of growth, if you would like, is peaking. And that's true, that's the case. So Ryan, let me ask you, what is your take on this and the potential impact it may have on equity markets going forward?
Well, I'd say at this point in the US, at least, it's probably a foregone conclusion that the acceleration of economic growth is now starting to slow, but the level of economic growth is still expected to be very good and really above average for some time, as you know, as the US economy continues to recover. What I'll say is, just because the pace of economic growth peaks, which simply means growth itself is still increasing, just not at an accelerating rate anymore, does not mean stock prices can't continue to rise. We see in the chart that over the last 20 years, stocks continued to increase even after US manufacturing activity peaked in both 2003 and in 2010, because the growth rates themselves were still very good, above the 50 mark as seen on the right axis. And just to explain a little bit, the economic readings above 50 signify economic activity that's expanding and grew compared to the prior month. So the question is, why did stocks increase after growth peaked? Because again, earnings growth continued to increase well after economic growth peaked up until the next recessions. And right now, Jan touched on it a little bit. Right now the next recession does not look close, really given the level of stimulus economies have received.
So let me ask Steve here a question. If we don't expect the Delta variant to derail the economic expansion, and we also expect inflation, as you explained, to be maybe a little stickier moving forward than expected by the market, that doesn't sound like a very good recipe for bonds. So have bonds lost their appeal in a balanced portfolio?
Sure. So bonds can be susceptible if interest rates rise, because bond prices typically fall when interest rates increase. In addition, purchasing power of income from fixed coupons can be eroded if inflation rises as well. As the next chart shows, if we're looking at the bond market, the yield per unit of duration or interest rate risk has really fallen to historic lows for US and global broad high quality bond indices. So what this means is that bond investors are really being paid less while taking on more risk. At TrustPoint, we have certainly been defensive of this increased risk and have really diversified our fixed income positioning in treasury inflation protected securities, as mentioned earlier. Also shorter term bonds, and more importantly, maybe more dynamic opportunities in the global opportunity set. And some of these are global debt, corporate debt, foreign currency exposure, or mortgage-backed securities. So in addition to that diversification, we do think that bonds still can provide the balance to a portfolio that they have in the past. And this idea that we're hearing gathering more attention, that bonds no longer have a role in a portfolio, we think has been greatly exaggerated. So first we have to acknowledge that, excuse me, with yields as low as they are, the higher returns out of the bond market that we have seen the last few years will be difficult to repeat, going forward. However, we have to remember that there are other benefits that should not be ignored. And as the chart shows, core bonds have really demonstrated the ability to hold their value, shown in the red bars, and even appreciate during significant stock market declines, which are shown in the yellow bars. So this relationship between stocks and bonds during economic downturns has really held even at low yield levels. So the primary objective of bonds is, one, diversify equity risk, as shown in this chart, two, generate income, and three, to protect principal. Now, the bond market just did have its worst quarter since 1981 in the first quarter of this year, and the US Ag was down about 3.4%. It was down just 1.6% in the first half of the year, even though the 10-year treasury was up about 50 basis points. So negative 1.6 return for the first half of the year in the bond market, that can be a bad day for the stock market. So we definitely need to consider the primary role and benefit of bonds, the diversification I mentioned, income and principal protection in conjunction with expected returns going forward. So in our portfolios, we have been successful at kind of balancing that core bond exposure along with higher yielding dynamic bonds, really to enhance the portfolio yield and expected return while maintaining the true benefits of fixed income allocations in a diversified portfolio.
Thank you, Steve. I want to switch gears for a second here. We've also heard concerns from clients about the ability of the stock market to continue to go higher from here. So Ryan, what's our view on this, and is there any good value left anywhere in the stock market?
Yeah, and I think the answer is absolutely yes. I think in addressing that question, what I'd say it's important to really bifurcate or separate the market really into two buckets. So on the next slide, since the start of 2020, when the pandemic really began in earnest through about, say, October of last year, the markets were led by what we call growth stocks. And that's represented by the blue lines in the chart. Now, growth stocks largely consist, among other sectors, but mostly technology stocks and companies. And during these months in 2020, growth stocks were led by even more specifically by about 5 or 6 or so really mega cap, large technology companies that generated a lot of earnings, a lot of cash flow, and have business models that are well suited for what we have called, the stay-at-home environment. The outperformance by these, handful of really almost defensive and safe individual stocks was pretty dramatic. However, once it was clear in late 2020 that vaccines would be ready soon, value stocks, and cyclical stocks, kind of in some ways, quite a bit of overlap there, but value stocks really started to outperform as shown on the chart on the right, and even after the dates that are shown in the chart there. Now, if we go to the next slide, we can see that value or cyclical stocks, which often include financials, energy companies, materials companies, they tend to have their revenue and earnings cycles match up well with economic cycles. So as we see in the chart, these value sectors really took it on the chin for expectations for their earnings and profits to grow during the pandemic, which is signified by the lines that have the steepest drops. However, once economic optimism improved, along with the vaccine availability late last year, these value stocks saw their earnings expectations stabilize and really have had a huge upward trajectory since then that is continuing today. We expect this upward trend for earnings growth for the value sectors to continue, and that should benefit their stock prices really more than other sectors, including areas like technology that led the way, in most of last year. I should add too, that with the recent concerns around the Delta variant, which we have addressed today, value stocks have, once again, taken a backseat to growth in technology stocks over the last couple of months. But as we expect the world to move past the variant and, the US kind of leading the way and other international countries behind and then emerging markets behind them, we still believe value stocks will be the main reason the stock market should continue to go higher over the next 6 to say 12 months. Now, I want to go to the next slide and show that, and kind of finish my thoughts on how we think the stock market can move higher still by showing this valuation chart. And so this chart compares earnings valuations of international stocks versus US stocks. So in the chart, when you see the line moving down, that really has meant that US valuations are increasing relative to international valuations, and then vice versa. Maybe the simplest way to kind of explain this is to say that increasing valuations are often, analogous to increasing stock prices. And so when this what this chart shows is that since about 2009, around the great financial crisis, US stock prices have increased dramatically versus international stock prices. The last 10 years have truly been a great time to be a US investor. However, while on average, the US has, about a, in the chart it says 12.8% valuation premium to international stocks. So on average, US stocks are just have a higher valuation, or a little bit more expensive. That's normal. That has now grown to almost 27%. So this valuation gap, statistically speaking, is extremely abnormal and it's very, very wide. So historically, when we see extremes like this, a reversion to the mean often follows. And this really does look like one of those mean reversion opportunities if value stocks, which happen to be more broadly represented in international stocks, continue to outperform as we expect, along with this extreme valuation discount shown in the chart. It looks like a really good setup for international stocks. And I want to emphasize with our audience that over the last several months, as we have repositioned client equity portfolios, what we've done is to really have a greater exposure to both value and international stocks. And it's worked well. And we think clients will continue to be rewarded going forward over the next year for this repositioning.
Thank you, Ryan. So let's recap here. What we said is we have lots of support still from central banks and governments, something frankly we've never seen before. The Delta variant, we said, not a significant concern. On inflation, we believe it'll be a little more persistent than transitory, so investors must be careful about how to position portfolios. And we also said, as Ryan just explained here, that there's still interesting opportunities in equities, especially in the value cyclical sectors of the economy and internationally as well. So for me, these are the key takeaways from the presentation today. We'll now move on to the Q&A session of the presentation. We have received a lot of questions. We thank you for those. We will answer a few live. We're gonna still plan to conclude this meeting by 11:45 at the latest. If we don't address your question today, your relationship manager or portfolio manager will reach out to you in the next few days to provide you with an answer to your question. So let's take a few right now. Let me go through the list. I'll start with maybe Ryan. Topic we didn't address today, cryptocurrencies, buy or avoid. So I know you've done a lot of work on this. What are your thoughts?
Yeah, great question. I actually, the way I think about cryptocurrencies is that it is continuing to be really a large topic of interest with clients. And it's something that we as an investment team really continue to monitor. I'll say that we don't really have a formal opinion of or even a recommendation for investing or even not investing in cryptocurrencies. But I guess I'd say like with any asset class, whether it's stocks, bonds, alternative investments, I think the important message is we want to make sure that investors take the time to understand the risks of investing in cryptocurrencies. What we don't know yet is really how sustainable cryptocurrencies will be as a store of value or as an investment. I think what we can say, however, is that the price of cryptocurrencies have been extremely volatile, and investors that are looking to dip their toes into it need to be comfortable with this and should probably take, a longer term perspective and be patient. I think it's important to share that we have compiled several educational pieces about cryptocurrencies that we're happy to share with clients, upon request, that talk about the risks of investing in crypto, but also the potential opportunities that crypto may have in the future.
And as Ryan said, I think it's very important to be educated on the topic before making a decision, not the other way around. So if you are interested in cryptocurrencies, as Ryan said, we have a lot of material that we can share with you that will help you get a better understanding of the space. The next question would be for Steve. Floating rate bond fund, a good idea?
Yeah, good question. And floating rate notes, they tend to gain more interest and can be attractive in a rising rate environment. With floating rate notes, because the coupon resets generally every 30 to 90 days, floating rate notes generally have very little interest rate sensitivity. In addition to that, flows play a big part. Investor flows have an impact, as we typically see substantial flows into the asset class when rates are rising, and that can drive loan prices further. Again, always being aware of the risk. The risk here is with credit risk, as these loans are typically below investment grade, and the issuers certainly backing them can be negatively impacted by credit events. So we have had dedicated exposure to the asset class, but got out back in late summer of 2019. At that time, we weren't necessarily comfortable with the credit risk, given the economic backdrop that we were seeing of a little bit slower growth, among other things. So going into the COVID downturn in March of 2020, we had zero dedicated exposure to the asset class, which did work out well as bank loans sold off with the COVID downturn that we saw. We then saw an opportunity, got back in late 2020 using a manager or a mutual fund, which allocates to both high yield corporates and bank loans together. And it's done really well as asset prices have recovered and rebounded. So, floating rate notes, they are an asset class that has the potential, to reward investors, but you should also be aware of the risks. And that means sizing the position properly to ensure that the portfolio doesn't get overexposed to the asset class, because it can be very, very volatile during periods of economic downturns.
Thank you, Steve. We've got two questions here, two separate questions, but I think they're asking the same thing. So I'm going to group the two together and ask Ryan to talk about the rise in margin investing and the rise of the retail investor in the marketplace.
Good questions. What I'd say is, as part of our overall due diligence, we do pay attention to investment flows, and we've really monitored phenomena such as the recent increase in retail stock trading and meme investing, and what we've seen in GameStop and AMC, for example. There's a couple of things I think I'd say. The first is the level of equity exposure for individual investors has increased over the last several months. But if you look back, it's really still only on par with levels we saw as recently as 2017. It's only 4 years ago, and it's still well below levels reached after the tech bust in 2001. And cash levels are still only what they were in 17 and are still higher than in 01, 2001. So I don't think extreme levels of risk taking have been reached, at this time, even, as more individual investors have gone on margin to buy, to lever up and to buy stocks. The other thing I'd say is the sell-offs we've seen in meme stocks after rapid rises really has had mostly just a negligible impact on the broader market. And those are the investments where retail stock traders have widely used margin. So that extra risk from using leverage hasn't really materially impacted when those trades unwound. I guess what I'd say too is, at the end of the day, within equities, what we're really focused on is the fundamentals like economic growth, earnings growth, and valuations to manage risk.
Thank you, Ryan. Okay, so I think we'll conclude the call here. Steve, Ryan, thank you again very much for being part of the conversation this morning. Thank you all for listening in as well. Have a good week, and we'll see you next time.